Okay, let's go ahead and start talking about the remeasurement of a foreign subsidiary's trial balance prior to the consolidation process.
Remeasurement is used where the functional currency is the US dollar, but the local record-keeping currency is the foreign currency. If the functional currency is the US dollar, then that suggests, in a very loose sense, that transactions should have been recorded in the US dollar. When we convert from the foreign currency to the US dollar, our goal is going to be to attain the dollar amounts that would have been obtained if the various transactions had been converted to US dollars on a day-to-day or transaction-by-transaction basis. Now let's say we have a subsidiary in Europe which bought inventory on, April 3rd, 2014, when the exchange rate was $1.20 per euro. We'll go ahead and convert that inventory to dollars using that exchange rate. When the goods are subsequently sold, we'll convert cost of goods sold at that same $1.20 per euro rate. If our foreign subsidiary bought equipment on March 1st, 2012, when the exchange rate was $1.50, we'll convert the equipment to US dollars using that rate. Since we will have converted the equipment at the $1.50 per euro rate, the depreciation expense will also be converted at that same $1.50 per euro rate. Ideally, every time goods are sold, the sales revenue would be converted at the exchange rate that existed when the sale took place. Clearly, this is going to be a pretty heavy computational and record-keeping burden, so instead, if the sales are earned evenly throughout the year, if the sales are made evenly throughout the year, we might use the average exchange rate over the course of the year as a reasonable approximation of that day-to-day exchange rate. We're going to have the following schedule of exchange rates for our various financial statement elements under remeasurement. Financial assets and liabilities, we're going to use the current, that is, today's exchange rate. If we're doing the remeasurement on December 31st, 2014, we'll use the December 31st, 2014 exchange rate. Now, financial assets include things like cash and receivables. Virtually all liabilities are financial liabilities. Virtually all liabilities are settled in cash. You pay accounts payable, taxes payable, wages payable, notes payable, bonds payable, interest payable. All of those various liabilities are paid in cash. Very few liabilities are non-financial in nature. Non-financial assets, things like inventory, plant assets, things of that nature, are converted at the historical exchange rate from when that asset was first acquired. Now let's say that on January 1st, 2015 we acquire a foreign subsidiary. From our perspective, time begins on January 1st, 2015. So all of the non-financial assets that the subsidiary owns on the date of acquisition will henceforth and forevermore be converted at that January 1st, 2015 exchange rate. Similarly, as mentioned earlier, expenses arising from these non-financial assets are also converted at the historical exchange rate. If a patent is being converted at $1.20 per euro, then the amortization expense is also converted at $1.20 per euro. If the inventory was converted at $1.10 per euro, then we'll convert cost of goods sold at $1.10 per euro as well. We're going to run into a problem where we have different historical exchange rates for different assets. Again, if we acquire a subsidiary on January 1st, 2015, all of their property, plant, and equipment will be converted at the January 1st, 2015 exchange rate. But after we acquire them, they're going to continue to acquire more plant assets over their existence. And so if they acquire some on June 1st, 2015, that asset will forevermore be converted at the June 1st, 2015 exchange rate. If they acquire more on March 17th, 2016, we'll have to use the March exchange rate for converting that asset forevermore and the related accumulated depreciation and depreciation expense. So we can run into a problem where we have rather elaborate schedules of different categories or groups or pieces of non-financial assets, all of which need to be converted at different historical exchange rates. Regular revenues and expenses, which are earned or incurred evenly throughout the year, we're going to use the average rate. And again, the rationale there is, although we would like to convert these at the rate that existed when that transaction took place, if those revenues or expenses are earned and incurred evenly throughout the year, using the average yearly rate is a reasonable approximation of what the day-to-day rate would have been. If we have one-time revenues, expenses, or gains or losses, for example, if we sell a major asset on March 1st, ideally we would use the March 1st exchange rate to convert the gain or loss on that sale. Again, generally, we're going to, in the interest of expediency, we'll just use the average exchange rate during the year as a reasonable approximation. Our paid-in capital accounts, common stock, preferred stock, additional paid-in capital, are going to be converted at the historical rate from the date of acquisition. And so again, if we acquire a subsidiary on January 1st, 2014 at $1.40 per euro, the $1.40 per euro rate will be used henceforth to convert common stock, preferred stock, additional paid-in capital, and so on. Retained earnings can be a little confusing at first blush. In the year of acquisition, we're going to convert it at the historical acquisition date rate just in the first year. In subsequent years, we're going to carry forward the dollar value of any retained earnings from one year to the beginning retained earnings in the following year. Basically, we're going to take the dollar value of beginning retained earnings, add the dollar value of income, subtract the dollar value of the dividends to get the dollar value of ending retained earnings. That dollar value of ending retained earnings becomes the dollar value of beginning retained earnings for the following period.